Well, welcome back. Well, we've been on quite a journey so far in this course, and if you're watching this module, then you have completed the majority of the program and are now ready to take the next steps. Before we move on, a quick review of where we've been and the importance of each module. We have taken you through an introduction to the currency market where we provided knowledge on why currency market exists and how to value a country's economy using fundamentals such as interest rates, GDP, and employment. Who trades in the market? Banks, companies, countries, and individual investors, and provided you the insights into these investors. The benchmark are 8 major currencies that are traded: US dollar, the European Union's euro, the Swiss franc, the British pound, the Japanese yen, and the Canadian dollar, the Australian dollar, and the New Zealand dollar. The currency pairs and how they fluctuate with respect to one another and how they are positioned. Then we examined market fundamentals and technical analysis. We took a deep look at the importance of fundamentals and the technical analysis and the initial insight into which instrument might be right for you when you're making your first investments in currency. We looked at the forces behind the scenes that affect the value of currency, the drivers such as interest rates, interest rate differentials, economic growth. We showed you various indicators you should be aware of the effect the market and what reports are best to follow. We also gave you tips on forecasting economic conditions. What are the fundamental drivers? What are economic indicators? Sentiment, confidence, and safety. Personalities of the currencies. The personality and performance of the US dollar. How to conduct your own fundamental analysis, and exercises for you to be conducting your own fundamental analysis in practice. In the technical analysis module, we together discovered that fundamentals help to answer the question of what to trade, and technical analysis helps to answer the question of when to trade. We looked at the technical aspects and trends for currencies. We were shown the tools for answering the question, when should I make the trade? We learned that good investors and traders rely on price charts and volume charts and other mathematical representations of market data called studies or technical indicators to find the ideal entry and exit points for a trade. We examined some charts, technical indicators, how to cash in on short-term currency trends, how to use indicators to identify trends, drawing trend lines, plus trading styles, technical triggers you need to learn, and exercises to help you do your own technical analysis. And then we focused on 5 specific instruments you can use when trading in the currency market. That's CDs, ETFs, options, spot forex, and futures. Let's take a quick look at each of the instruments. Currency CDs for those traders who want to take advantage of the values of the world currency market and are looking for a buy and hold, lower risk type of investment. ETFs, or exchange-traded funds, that are traded much like stocks on the stock exchange. Trading currency ETFs gives you the potential to grow your wealth steadily without the unlimited risk of margin accounts or futures with as little as $100 per investment, no matter what's happening in any of the investment markets. We reviewed currency options, which give you a right to buy a currency, but not the obligation to buy it. It is an option to buy and is a very good way to lower risk. Currency options are very easy to understand and trade. In fact, they work just like options on indexes. And they can be bought and sold in your regular brokerage account. They can also provide a triple-digit return potential if you use leverage appropriately. The spot foreign exchange, also known as Forex or FX market, trades about 3 to 5 trillion per day and has 24-hour dealing, 6 days a week, a vast liquid market, making it easy to exchange most currencies. The ability to profit in rising and falling markets, recognized instruments for controlling risk, leverage trading with low margin requirements, and zero dealing commission. The spot market offers great opportunities for profit, but it is higher risk than other instruments that we discussed in earlier modules. We finished the instruments modules with futures, the highest risk instrument, but with the greatest profit potential. Futures contracts are financial assets just like stocks or bonds, but with some important differences. The modern futures market evolved not from a need to raise capital, but from a need to transfer risk. The futures market makes it possible for those who want to manage price risk, the hedgers, to transfer that risk to those who are willing to accept it in the hopes of profit. We call them speculators. Currency futures are futures markets where the underlying commodity is a currency exchange rate, such as the euro to US dollar exchange rate, or the British pound to US dollar exchange rate. Remember that futures is high risk, and if you're not an experienced trader, then you should look to one of the other instruments for your initial currency investments. That wraps up the summary of what the modules we covered. We are now going to move into an interactive question and answer with our gurus on what you should do next. But before we do, we just want to remind you that currencies are a fabulous market where you can make unlimited profits. But you can also lose money if you're not prepared and don't follow prudent strategies. When you're starting out in currencies, please do not invest all of your money. Take 5 to 10% and make it your investment capital. At times like these, the prudent thing to do is to keep the majority of your money diversified. But if you've done that and you have some risk capital to leverage, this big trend gives you a lot of opportunity. Investments that could multiply your money many, many times over, and you can't find a better investment than currencies. You've met all of our gurus during the modules already, but for a quick review, on my very right is Sean Hyman. Next to me is Kat Van Roer. On my other side is Evaldo Albuquerque, and of course Barry Nobel, which we've had throughout the program. Panel, we've looked at all the basics, the fundamentals, the technicals, and the instruments. I'd like to ask you some questions and get your candid response on each, if that's all right. I'm sorry if I dig a little, but this is the time for our viewers to really get to know you. So let's go ahead and begin. All right, first of all, I hear the term look before you leap quite often in investing. And what does that really mean? Should I be setting up a practice account, or what should I be doing before I place my first order? Kat, I'd like you to take that one if you could.
Sure. Well, there are a lot of things you can do. If you've gone through this whole course and you still don't feel, 100% comfortable with, say, Forex trading, you can set up a practice account. You can go to one of many different Forex accounting firms online and basically just pull up a practice account and start trading. And then once you placed your first practice trade, you can get comfortable with all the triggers, indicators, specifically how to place a live trade, the platform, and overall it'll make you much more comfortable and to a point where you can start, actually putting money in this market.
Now that sounds like a pretty important piece of advice to get started and get yourself. But is that what they mean by look before you leap, or is this kind of a little, have any other meanings to it? Anybody else want to share with it?
Yeah, well, many of the online firms have virtual trading. Every one of them treat, if you want to trade virtually currency options or currency options, you can do that virtually in your account. Virtual trading is good. It's a good way of understanding operationally how you want to enter a trade, but it doesn't allow you to feel what it is to actually trade. Do you want to expand on that?
Yeah, I was talking with him last night and mentioning that demo trading is good for learning the mechanics of a trade, how to place a buy or a sell or a stop or a limit, and any of those little mechanics type things. But after that, really, when you place a demo trade, it's still different from placing a live trade because there's an emotional attachment to that trade. I don't care if it's $5 or $100 or $1,000 on the line. Even the least little bit, we still have some skin in the game.
Yeah.
And so we will think of that trade differently than we will a demo trade. So I could place the biggest order in a demo account and go sleep like a baby. But I probably couldn't do that in my live account. So there is the emotional, psychological side of trading that I think you really work through when you open a live account. So do the demo account first, get used to the mechanics of trading like they're both saying, then go into a live account, maybe a small account, and with a little bit of money, just a little bit, and get your feet wet, placing one lot trades at a time, starting very small, and from there, and get ready, get used to managing that trade. And then you'll be ready for to step up later on in some bigger trades.
It turns you into a observer to a trader, or an investor.
All right.
To add to that,
Sure, please.
you were saying to place a one lot trade. I would go even further and say place a micro lot trade, which is the tiniest form of forex trading that you can actually do. One lot is standard lot. That's really what should be trading when you're kind of a veteran trader. You know what you're doing. Micro lot, you're putting up very little leverage, very little money, and it gets you in there much faster.
Let me push this just a little bit. I mean, people are going to ask me, and they have asked me, so should I put $500 away, $1,000, $10,000? I mean, I'm trying to really figure out if you were starting out in this, maybe what would that dollar amount be?
Yeah, I can offer up something there.
Okay.
If you start with a micro account, like Kat said, I would probably start with something small, like maybe $500, somewhere around there, and start with those one micro lot trades. If you're wanting to graduate to something a little bit bigger, once you're comfortable with that, you can go to a mini account. And a mini account, I would say probably start with maybe about $5,000 or more. $5,000 to $10,000 is probably a good, comfortable range there. So that's the dollar amounts. For the few people that would want to look at percentages, I would say probably only 5 to 10% of your overall net worth would you want to put in something like this as well. So you can look
that
at
would be
dollar-wise
as
or
you get more
percentage-wise.
comfortable with it. But I'm looking to start, and
Yeah.
I want to try this out. And as you both said, putting money into it. And yes, I can play with $500, and I'll get a little emotional on it. And I put $5,000 on it. I'm going to be a lot more emotional on it.
Right.
So I'm just kind of getting a feel, and I think people appreciate, because this is probably often a question that people have to ask themselves: how much should I begin with? Where do I look to set up the account? How do I actually choose a broker? How do I, in one of the other modules we said, find a reputable broker. How do I know that they're a reputable broker, and which is the right one to go with?
I would recommend first trying out the platform to see if you're comfortable with the platform. See if you're comfortable, see what kind of technical support you'll get, what kind of educational support. Do they offer courses, free courses?
Now, is that courses in currency like we're doing here, or courses on how to use their software and
Both.
platform? Okay.
Most brokers, they offer both kinds of educational support.
Okay. But that's an important point. So then.
And the other thing is to look at the spreads. Always shop around to see what broker offers the lowest spread.
And how would you
transaction
determine
cost.
that? Is it something that you can ask for, or is
Yes,
it
you
just
can call the brokers around and ask what's the spread in a specific currency that you're looking to trade, and compare the spread.
And so you want to find a broker that has a low spread, has a good platform, good education. How do I determine if they're reputable or not?
To me, reputation, it usually goes hand in hand with regulation as well. Because in the world of currency, I mean, you can set up shop anywhere, and there are places you could go and dodge regulation, or there's places you could go and set up shop and really embrace that. And so I think the reputable firms really are regulated by several highly thought of entities in the United States, the UK, several places in Europe, Canada, Hong Kong. These type of places, if you find entities in any of these types of countries, they are highly regulated. They have to meet a very high standard of capital requirements and things of that sort. So you've got somebody looking over their shoulder, making sure they're staying on the straight and narrow, and also that they're meeting capitalization requirements to run their businesses safely as well, so that it becomes a safe place for you to trade.
Well, that's kind of an interesting thought, and I hadn't really kind of figured on before. Is that I'm looking to work with brokers that are in countries that are regulated, and how do I find out that information? Is that on their website someplace?
Yeah, you can go to sites like the CFTC or NFA's sites. SEC as well. I mean, several of these, the regulatory bodies will tell you, who they regulate. Some of them even will tell you, basically the size of those firms, the capitalization requirements they have to meet, the excess cash that they have, on capital to meet any type of reserves or requirements. So it really is good for the public to know.
So really do your research on the brokerage you use. And I have one more kind of follow-on question to that space. You mentioned that these companies might be overseas. Does that mean that my investments are going to be held overseas, or are they going to be kept in the U.S.?
Sometimes yes, sometimes no. There are some firms that are global, and so they'll have branches like in the UK, but also have them in the US. So you could have a UK account, but everything still be really domiciled here. So everybody that you dealt with, customer service and that sort of thing, could be here. Your account could be still denominated in dollars, even though it's in a UK branch, for instance. So it can be either one. You can have
Makes
it
a lot of
overseas and in foreign currencies, or you can still have it based in dollars and domiciled abroad as well.
Many of the firms that we as a listed exchange, an exchange, our domiciled accounts are here in U.S., regulated by U.S. Securities Exchange law, and have support and have expertise in order to trade and offer these products.
Awesome, awesome. That's just an important point, because I once went and set up set up an account on an FX online account, and then next thing I know, I got 50 of them all trying to get me to come over to them, which is perfectly okay, but I don't know which one is the right way, and I didn't even know how to research them. Right. So when I wanted to transfer money to start actually trading, I want to make sure that I have the right kind of broker, has the right kind of support, has the right kind of education to go along with my investment. Next question, if it's all right, if we move on. We often talk about stops. I hear it all the time in everything I do. I mean, do put a stop here, this. And so what are stops, and how and when do we actually use them?
Well, a stop loss is exactly what it sounds like. It actually stops your loss in a particular investment. It's a level at which you are closed out of the trade, so it thoroughly minimizes your risk. So, for instance, say let's just look at stocks for an example. Say I invest in IBM, and I only want to lose 20% on that particular investment, at most.
Right. I want to risk 20% on that investment. I don't really want to lose 20%.
Well, ideally, I want to make 150%.
Absolutely, that's where I want to. But I understand what you mean.
But should it go the other way, the most
Yeah.
I want to risk is 20%.
Perfect.
The 20% would be my stop loss, and you can do the exact same thing in forex trading. You can do the exact same thing in ETFs.
Now, how do you actually do it? Is it actually an option in the trading platform?
It's an order type. And
Okay.
what we'll do is we'll take an order. So let's say you want to buy a U.S. dollar, a euro call, and you want to buy the 125 euro call, and if it goes, and you're paying $3 for it, making this number up.
Okay.
But if it goes to 250, you want to stop loss.
Sure, you want out.
You want out, and either that will be kept at the brokerage firm, and they'll keep the stop loss and enter it for you if it hits 250, or sometimes it'll be kept at the exchange
So
itself.
when I do my order, if I'm ordering with a broker, I just tell them I want a stop loss at this point.
That's exactly right.
Okay, great.
For options specifically, a lot of people also choose to keep what's called mental stops, which is it's just what you believe, what you say you're going to get out of a particular position, and then if it drops to say 250, you're going to call your broker and say, okay, that's it, close me out.
Okay, so
I'm sorry, without getting too confusing, and some people use stops. Let's say you buy it again at $3, and it goes to $3.50. They'll put a stop loss in at $3. If it then goes to $4,
Right.
they'll follow the stop at $3.50.
so you kind of a moving stop.
Yes.
I've heard
So we take
over my
profits.
years of trading that some of the best traders, why they, you can't hit a success every time, but the way they use stops and leverage stops along with their investment strategies, that's how they actually make money. So they don't let it go too far back, but they keep growing it, and exactly what you said.
And forex trading, Avalo actually does that all the time.
Is that? You want to share that?
If you trade in the forex spot market, I would
Yeah.
recommend to always set the stop loss before entering the trade, because if you wait to set a stop loss after, your emotions will influence your decision. So you want to set a stop loss before entering the trade always, and always have a stop loss.
Now there is one of those types of things that I call a golden nugget, right? Is you put in the stop loss before you make the trade, not after you've gotten emotional about it.
You'll know how much capital you're risking on the trade. That's the only way you'll know for sure how much capital you're risking. And most traders have no idea how much money they're risking on that trade, and that's a big mistake.
Now, that is great advice. Write that one down. I hadn't thought of it, but that makes great sense. Thank you, Evaldo. Appreciate that. Let's see. Let's move on a little bit. Maybe you can give me a little bit of a philosophy on risk management. We obviously did stop loss, so what are some other things I can do for risk management?
Yeah, stop loss is part of that equation, and some people stop there and think it's the only part of risk management, but really it's one piece of it, because you can set a stop based off of a technical level or something of that sort, or just a certain dollar amount you want to lose, but you also want to think of it as in a percentage term, like of my overall money in that account, how much am I comfortable with losing if this trade goes wrong? You know, because some people, they'll let it move 30% or something like that on them before they exit that trade. Well, that's far too big of a pit for you to crawl back out of.
I would
But
think
if
so,
you
especially
keep
in currencies,
yeah,
too,
if you
'cause they
keep
can move
that
so quickly.
if you keep those holes dug very small, you can hop at them fairly easily and get back into profitability. So you really want to think, you know, most pros think anywhere from, you know, 0.5% to 5% on the small and large end of what you would want to risk in your account's capital at any one particular time. So if everything went haywire and you got stopped out, you know, you want to be comfortable with it being that small sliver of your account that got stopped out and not 10, 20, 30, 40% of your account balance. So,
Okay,
so think in percentage terms as well.
Sure. And that's the stop. So what other things might you do on risk management, other things in your investment strategy? I mean, you gave us a good one there about making that decision on for risk management, putting that stop in before emotion, you know, takes over. What other things could we do?
Your whole portfolio. Everything I have, most of everything I have is in US dollars.
Okay.
And I don't think a lot of people think that they're 100% in US dollar. And I think that you have to start to believe that you start to look at what is the US dollar worth versus the yen? What is the dollar worth versus other major currencies? You say, maybe the dollar is not the most opportune place to be right now with 100% of my value or my net worth. And you can use a portion of your overall portfolio to leverage and to hedge a part of your overall net worth in other currencies.
Yeah.
Now, you know, sometimes the yen is a safe haven.
Yes.
Sometimes the dollar, as it's been, is a safe haven. But things
Absolutely.
change, and it's never the same. That is what these guys do extremely well. They look at it, they research it, and they understand what is happening in the currency markets. But once you start to look at it, you start to see very clearly the flow and what is happening globally in flows of money. So I look at it as not only a technical way of hedging, which is stop losses, but also a way of preserving one's wealth.
That's interesting, and correct me if I err here on this one, but most of us in our portfolios like to diversify. We hear diversification all the time, and that's kind of a risk management strategy. But we don't diversify out of the dollar. So
Americans don't.
that's another one of those nuggets, I think, that when you're really looking at it, I've got everything invested in the dollar, and I've watched the dollar, unfortunately, for people like myself, go down in value against other currencies, and it becomes more expensive for me to buy products and services that are imported from other countries because of the dollar value changing. Now, of course, that bounces up and down, but I'm not diversified. I'm 100% in a single model of investment, and I've just diversified within that investment. So that's a great piece of information and a great nugget for moving my investment strategy around. So that was a great answer. I really appreciate that one. Let's say I want to now evaluate a potential currency. So going back to some of the fundamentals and the technicals and the things that we've talked about, you know, what are the key indicators I want to always look at?
A good way to look at it is, as we've been saying, to start from the fundamental and then weave down into the technical. For the fundamentals, the easiest way to do it is to look at things like the country's overall debt, the local unemployment, what the local stock markets are doing. You know, if they're crashing, it's probably going to affect the currency. And then once you got the fundamentals looked at, and you're evaluating the fundamentals, you go to the technical side, which is many of the indicators that we've discussed here. Things like long-term trends, small moving averages, that sort of thing.
You know, and one way to simplify that too is to build upon what she's saying is that the fundamentals answer the question of what to buy, but they're not always so good about telling you when to buy it. And the technicals are good about telling you when to buy it, but you want to make sure there's some meat behind what you're actually buying, and so that's what the fundamentals do best. So they definitely both have their spotlights that they shine in. One tells you what to buy, and the other tells you when to buy.
Yeah,
That
and
particular
there's a
product.
cycle there, so that's an important place. Now, in some of the modules, we mentioned things in the fundamentals module. You mentioned things like the CPI, right? As that, and in GDP and those types of things. Is if I was to pick one or two things that I must always look at outside of technicals, because I have to look at the chart, could you kind of give me an idea of what those 1, 2, or 3 things might be?
I would say CPI, absolutely.
Okay.
CPI overall. Because all current currencies are driven by inflation, and inflation specifically affects central bankers' moves. And central bankers' moves obviously will move all currencies all over the world. Inflation in general, you always need to know where a country's inflation is. And the CPI can tell you that.
I think interest rates.
Yes.
Because it really comes down to interest rates. And something that, I don't want to get technical, but something you can really talk about is the carry trade. If interest rates are higher in one country than the other country, many people will take, if interest rates are higher in another country, I will take my money that's earning almost nothing in this country and invest it in another country. I mean, it could be whatever country that is. So it's the carry trade. But the interest rates are a result of exactly what you were talking about. It's the CPI, how much inflation there's going to be, and the central bank tries to monitor the inflation by interest rates. So it's very interesting how the technical and it's all interwound.
Absolutely.
But if you read, and you just read it every day, as you all do, you start to understand fairly quickly how it is all interwound.
It sounds a bit like what he was saying about putting money in and get really involved in it. And so, super. Let's see. We've talked about a lot of different currency investment strategies. I mean, we spent on the 5 different instruments. What advice can you give about picking the vehicle? I mean, we saw CDs, ETFs, options. I mean, and I know each of you have kind of a preference to these spaces. That's why we have you here. But we can start a little battle here and see who wins. But what are a couple of strategies? Give me a piece of advice. I'm fairly new. I'm not a novice of investing. Okay, I've invested for the last 20 years. I've won some, I've lost some, and I've won some again. But I'm not familiar with the currency market. I'm new to that. So where would you say I start?
It's a good question. It's a great question. I like options.
I never would have guessed.
Because, who would have guessed? And I'll tell you, I'll wrestle you all to the ground.
Yeah,
Because I really
well,
do.
you are
I'm
at the
passionate about
NASDAQ, and you do run the options service. So
Well, I manage the options service area with some people I do. But I like it because there's limited risk,
Yeah.
and you know the risk before you start to trade.
Right.
You understand what the risk is, the premium of the option. Now, I'm not saying that it's the only
Right.
product, but it's where I start, and I understand it.
And to add to that, here's a way that I envision a lot of products. I envision them like a pyramid. You've got your wide base that goes up to a small peak. And your wide base is kind of like your foundation, which you can start with simple things. Kind of ease into this thing. You can do the currency CDs, which are fairly conservative. You can step up a little bit more and do like the currency ETFs. You can step a little bit more and do the options. You can step up a little bit more as you're growing towards this peak and do spot forex, which is a little bit riskier, and the currency futures a little bit riskier as well. But so a big broad base of your money can be in something conservative, and as you get more comfortable in this market, you can move into these other products that have higher potential reward, but you're also coming more armed with more knowledge as well.
Go ahead.
I would also add to that, most people already know what kind of investor they are. I mean, if you're the type of person who likes to check the markets, every hour, then you're more of a trader. If you're the kind of person who likes to, check your portfolio once a month and then go fishing, then you're more of a long-term investor, and you should be looking more in the CDs and ETFs. But if you've been trading stock options, for years, you might want to look more into the currency options.
You're absolutely right, Kat. You're absolutely right. If options are for an active investor. You're right.
It's based on really who you are, what you do, and what you've been doing in stocks, commodities, any other market really can translate into currencies. It's all about that pyramid that Sean just mentioned.
Like any other investment, it depends a lot on the level of risk aversion of each person. So it's very subjective.
Yeah. Now you kind of almost read my next question, because I was going to say is how much time do I need to invest in each of these instruments? Which one is the most time? Obviously futures, and the least time I would imagine would be CDs. And just maybe one other free form question that kind of occurs to me is we've talked about the majors, And in this case, we're defining the 8 majors of the world. And then we have these exotic currencies that we've also briefly talked about. Maybe just a little insight of at what point in my trading career of currencies that I may want to actually step outside of the majors and into the exotics. Any thought on that?
Yeah, I like to trade exotics, and that's my focus when I follow the currencies, just because they are so much more volatile than the other major currencies.
They sound like they're more fun than some of the other major
Right,
currencies.
yeah.
You're also on the red edge of the table just a little more.
Right,
But yeah,
yeah.
okay.
Yeah, but if you have the right risk management strategy, you can use that volatility to increase your profit. So that's what I like about exotic currencies.
Okay, so should I be trading 3 months, 6 months or something in the space before I look at it, or should I just look at it right away?
Well, as I said, that depends on your level of risk aversion. If you really like risks, then you can start by trading exotics.
Okay.
One thing that you can look at too is the majors are a little bit more conservative than the currency crosses, which are all the majors with the dollar taken out of the pairing. So it becomes a little bit more risky because it's a little bit more volatile, and then the exotics are a little bit more volatile than that. So you can kind of really compartmentalize it and gauge it in that in that regard, and really kind of see, okay, where do I fit in that risk profile that Evaldo talks about.
Yeah, and as we said kind of earlier, that as it becomes a little more volatile, it becomes, you have a little more profit potential, but you also have bigger loss potentials.
Right.
So that's something to do.
Well, technically, we just talked about risk management, and both these guys, can tell you how to manage your risk. In specifically, if you're doing exotics, or you're doing currency crosses, or you're doing regular forex trading, you're really risking the same amount of your account with each trade. The bigger risk comes in the fact that they're just make those moves a bit faster. But if you have a stop loss in place, technically it's the same amount of risk.
All right, but I think our recommendation is that initially, we start with the majors and understanding the majors and how they work, and then move into the more volatile opportunities that maybe the rest of the world brings to us. I had a funny thing, and this has been great, but right in the middle of we were filming this program, I had a phone call on one of my breaks, so I called. It happened to be one of my brokers. I have some very conservative investments in bonds and things that I bought years and years ago that were very high returns, so I didn't bother to get rid of them. You couldn't earn anything. Unfortunately, they're starting to mature and they come due.
Sorry to hear that.
Yeah, I know. It's too bad, because what happened today was at like almost 5.25%. I'm like, oh no. But so be it. That's what happens. And he says, I really can't give you a whole lot of options, or no pun intended, not choices here to give something that will give you anywhere near that kind of. And I said, well, it's really funny that you should call me today, because I'm in the midst of working with some amazing people that are traders and investment minds and advisors in the space of currencies. And I said, and I've learned a tremendous amount about every type of instrument and all of these different pieces. And he says to me, he says, well, Bentley, he says, there's a lot of risk associated with, trading in currencies, and you really got to know a whole lot about it, and I don't really advise it for you. And I'm sitting there saying, I said, didn't you just hear what I just said? Why did he do that? Currencies sound like the great opportunity of diversification and risk aversion if you have it, and safety. Why would a broker do such a thing, or say such a thing? Not really do, but say such a thing.
I think that there are a lot of brokers out there that really understand currencies.
Yeah.
I think that people that are in pockets in this country that are made up of foreigners really understand currencies. I don't want to pick anyone out or any area out, but if you go to South Florida, Miami, they really understand it because a lot of foreigners are there. It's what I spoke about before. Most people in this country are very centric as to risk. They don't really think about dollars as an asset or a value of an asset. And I'm sure, and within his firm, there are people that truly understand currencies.
And they're probably, I know the firm, it's a big firm. I'm sure they trade currencies all day long.
He will find out, and he will call, or she
That was just a surprise that I got a kick out of. This is a true story. I mean, this really happened
great.
right in the middle of it. And
Yeah.
Any other thoughts or anybody?
Yeah, it is weird because they themselves will have whole departments that that are currency trading divisions within their own firms. Every major firm has them, so they all deal in these as well. But when it comes down to a broker level, I mean, me being a former stockbroker
Yeah.
as well, a lot of your emphasis is, like he said, on the U.S. So when you are really trained as a stockbroker, it really is U.S. centered for the most part. And so it is really U.S. mutual funds, U.S. ETFs, U.S. options, U.S. stocks, U.S. And so there really is sometimes a little bit of a deficit in the industry overall. So I would suggest working with somebody on that portion of your portfolio
Right.
that is very comfortable with currencies and currency recommendations, because like we've discussed, there's all kinds of different risk temperaments.
Yeah.
You can be fairly conservative and still be involved with currencies, CDs or ETFs or whatever, and
Yeah, well, that's
all the way
what I've
all the
learned.
way up to the faster, zippier stuff, like spot forex or whatever. So it's not a risky asset in and of itself. To me, risk is having everything all in one basket. And that's
well,
what we've
that-
done.
and-
We've got
and that's
everything
what
all
I
in
am.
that dollar
I'm all in
basket,
one.
just like you said.
Yeah,
So to me, that is the ultimate risk,
Oh, you're
is
big
having
now.
everything there.
Well, I think, okay, I'm sorry.
Sorry.
Yeah.
Another comment on brokers. I mean, a lot of the things that we're talking about are brand new. But I mean, 10 years ago, if you were talking about currencies, you would be talking about forex trading, and
The
so
spot market,
you would be talking about the spot market, and that's all there really was. I mean, it existed. You get into it, but brokers were used to saying, "Oh no, that's complex. People don't know
And
this
it
sort
is.
of."
I mean,
people
you
don't know
really
this
need
sort
to
of
know
thing.
something.
But options, ETFs, currency ETFs have been around for 5 years. Currency options have been around for a few years, 3
Yeah, a few
years.
And the new currency options cash settled. But it goes to this. This is brand new.
Yeah.
And it's something that you said that really hit my thought, is that the products are new, but most importantly, the information that we use for the products are new.
Absolutely.
A few years ago, the central bank would release some information. You'd have to retrieve it from downtown New York, get it, digest it, read it, and then compare it to the central bank in St. Louis or the central bank's release in Boston. You'd have to understand it, and God forbid you're trading exotics. Today, I was watching you guys, and you were pulling real live information of what is happening in inflation around the world. It gives you opportunities that never existed before to understand the markets, to see what is happening in real time, in quotes, in real time, and being able to take advantage and manage your risk. It's never happened before.
Well, it's super, and I imagine this is going to happen with other brokers when the call comes in or something. And so I just wanted to kind of share that with our students that just be aware they may not know about these new instruments as Kat has just described. They may think of the risk of spot and if you're a conservative investor, as that particular portfolio that I carry is very conservative. I can see, his response. But I thought it was actually, it's put a smile on my face. I said, I'm going to prove that wrong. So I've truly enjoyed it. Is there anything else that you guys all of you would like to share before we close this?
I'll say one thing. The call I always get is,
Yeah.
people are always looking for the Holy Grail out there. And
Yeah.
really, I found as close as you can get to the Holy Grail, and believe me, I've looked and searched long and hard for it, but it really boils down to two simple things. One is following the trend that is, up, down, or sideways trend.
Yep.
So follow the trend of what's happening.
The trend is your friend.
Yeah,
Right?
exactly. And follow good risk management principles. If you couple those two together, you will
Yeah.
find that you have an edge in the market, no matter which one of these products you use.
Right.
You follow the trend with the ETF, with the options, what the underlying's doing or whatever. But follow that trend, use good risk management, and really that's your edge.
All right, and along the way, I've been collecting the little nuggets of great items that we've learned in the program, and I'm going to let each of you. I mean, I've written them down, but
You've been busy.
I've been busy. I've been listening. I've been learning. I actually want to go out and start trading right now. I'm that excited about it. So it's really great. Maybe you want to
I'll
provide
start
us
on
with
that.
your nuggets,
I
okay,
do.
around
My
the
nugget
table.
is this. Begin to trade. Do a trade. As
Right.
small as it is, do a trade. Once you do it, you'll understand it. Don't expect that trade to make you a millionaire or a billionaire. It's about hitting singles
Okay.
and understanding it. That's really what it's about.
Good point. Okay, Evaldo?
In terms of risk management, you should never risk more than 5% of your trading account in any single trade.
Okay, that's good.
I'd say overall, if you are completely dollar focused, I would look to putting 5 to 10% of your overall portfolio in a long-term currency investment solution, just to give you some kind of diversification.
From the dollar. That's a good point. Great. And
Yep. And then my nugget is, the demo account is great for market mechanics and learning how to do that, but a lot of people think if I become successful at trading in a demo account, then that totally equates to me being successful in a live account, and it does not do that. That's where it becomes a fallacy. So learn the market mechanics in your demo account, and once you're comfortable with learning how to place a stop, a limit, the number of lots and whatever, shorting in the account, then take your steps over into the live account and and deal with that emotional, psychological side of trading, because really that's where a lot of the game is. It's not just in calling the right direction in a trade. Really, it's managing those emotions along the way in that trade.
Yeah, very, very important. And I'll go back to the one we learned actually here in the panel that Evaldo brought to the table was put your stop loss stops in before it becomes emotional, because then it becomes a panic. That's a real winner right there.
Yeah, before the trade you're rational. You may or may not be that way once you're in the trade.
And there's a place in your companion workbook to actually write down all of these different little nuggets that we have and collect in there, as well as some exercises from the earlier modules that we talked about. Also asked each of the gurus here to provide you with their 5 top recommendations for the different instruments that are there. You'll find that also in your workbook and a lot of other information. There's a glossary of all of these terms that's available to you. And then as we were building this, all these new acronyms and terms and phrases, and that's also in your book that tells you what these things actually mean. In fact, we gave you a little extra, just a few of them, because as I found, some of the acronyms are reused 2 or 3 or 4 or 5 times in this industry, and they mean different things. So it's real important to understand what we're talking about when we go down through that. So thank you all for your time and your support and all the effort that went into this program. It has been just a wonderful experience for me, and I hope it's the same type of experience for our audience in this place. I hope you've enjoyed it as much as I have in working through this. So I just thank you for this. I'm just very, very excited. And I thank our audience for the time and the dedication and the effort that you've put into this program to make it a success for you. So for right now, I'm going to close the panel and say thank you, and we'll be back with a few other last things before we close. Barry?
Thank you.
My great pleasure. Evaldo, same here. Kat and Sean?
Thank you.
We'll see you soon. Thank you and goodbye.